Hello and welcome to this Thursday edition of FreightWaves Now. I'm your host Anthony Smith, and we have a full lineup for you today. Luke Falasca is back with us, and he's going to give us an update for the brokers. We also have Mike Baudendistel here with us, and he's going to give us a Rail Intermodal update. But first, we're going to go to Zach Strickland with the carrier update, brought to you by PowerFleet. Stay tuned.
Hey, and welcome to your Thursday carrier update presented by PowerFleet. I'm Zach Strickland. So we're watching our volumes in the country continue to climb. So one of the strongest single days in the outbound tender volume index is history yesterday in terms of strengthening. We're watching volumes really push through the country right now. Again, unprecedented growth this time of year. Traditionally, year over year, we're talking about 20 to 25% higher volumes versus 2019. That is pressing tender rejection rates even higher. We're now over 17% on the tender rejection index for the first time since way back in March when we saw that big panic buying surge of freight. So again, volumes increasing. Capacity continues to tighten incrementally alongside of it. How long is this going to last? It doesn't look like it's slowing down anytime soon. It looks like we're going to have a pretty bullish July going into the third quarter potentially. So looking at where is this freight moving? So we're seeing strengthening in volumes, but not all volumes are created equal. Looking at our long haul, tweener, short haul, mid haul volumes throughout the United States. Notice I've got our long haul volumes here on top, tweener volumes right there in the green, and then we hit mid, short, and local volumes down there in the orange, purple, and yellow lines. So notice that the tweener and long haul volumes have kind of flattened out here over the last little bit, whereas the mid haul and lower, so anything going under about 450 miles, we're seeing significant spikes in these shorter haul moves. So regional haul freight, shorter haul freight, local haul freight, all showing significant day-over-day increases in our index right now. That means that we're probably seeing a lot of DC fulfillment center movement going to endpoint end user. Not as much replenishment freight, even though there is still a significant amount of that moving through, but it isn't increasing at the same rate that the rest of these lengths of haul are. So any of you regional carriers out there should note that we are seeing increases in these shorter haul volumes. Throughout the United States right now, we're looking at general increases. This is our outbound tender volume index tree map. So generally, we're increasing just about everywhere across the United States right now, evenly or unevenly, I should say. A few of these key markets haven't shown as much growth. Atlanta, Georgia, we'll talk about here in a minute. One of the key markets in the United States, obviously the biggest outbound market in the U.S. currently. Single market, I should say, because if you combine Ontario and Los Angeles, you do have the largest area for freight in the United States. Ontario, a modest 3%. And I say modest because you look at some of these other figures that we're looking at right here. Memphis, Tennessee, huge 17.4% weekly increase in outbound volumes. Detroit, Michigan, big automotive center up there, 24.8% increase. Dallas, Texas, after taking a little bit of a breather, has returned to increasing after moderating a little bit. Chicago still kind of mid-ish, 2.2% increase. Lakeland, Florida. So anybody going into Florida right now should see some heavy contracted volumes coming out of there right now that'll support continued utilization. Again, throughout the country, we're seeing Midwest volumes generally increase with some large spikes throughout the United States. So Atlanta, that's a key market to watch for any carrier, basically a hub of the southeastern freight market. I want to break this one down a little bit more detailed. So we've got our head haul index, outbound tender volume index, along with our outbound tender rejection index. So how do we look at this right now? So head haul index in the blue. Pay attention to these big mountains right here in the blue. We can see a tremendous drop in the head haul index. So head haul index is outbound tender volumes less inbound tender volumes. The more outbound volumes you have in relation to inbound volumes, that means that you potentially run an undersupply situation for capacity, putting your capacity at risk if you have too high of a positive head haul index value over time and significant change in head haul index. So this right here is showing me that we should see actually increasing capacity compared to what we saw this time last, or at least a change in direction of the increase of capacity. It's much less than it was here in the early part of the year. Tender rejection rates hovering around 17%, tender volumes relatively flat. So this market looks relatively stable compared to the rest of the country, something to keep in mind if you're looking for spot freight out of Atlanta. And that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi, good morning, everybody. I'm Luke Falasca bringing you another broker update, and we're continuing to see volume levels retest the all-time high again, like we saw here of the last 2 times in March and then again right before the 4th of July. Notice that blue line there, that is that volume level there. You can see it right on that 12,900 mark there as we hit the peaks the last couple of times. So we'll see if we finally break that 13,000 barrier here over the next few days. But as you can see, we are nearly 30% higher than where we were this time last year. That green line is 2019 volume levels, and that orange line is 2018 volume levels. So very unprecedented for this time of year, especially when volume levels tend to kind of slip a little bit as we go into July, but that's not happening right now. We are continuing to surge higher and higher, and we'll see how long that continues. And of course, that is tightening up a lot of capacity. We're going to focus a little bit more on reefer right now because the reefer market is doing some interesting things. For starters, this blue line here, that's going to be your reefer volume levels. While reefer volume level isn't anywhere near the peak that it saw during that panic buy and surge in late March, it is significantly higher than where it was near the beginning of the year. So it is still seeing a lot of growth, a lot of good growth compared to where that panic buying surge was when all the grocery stores were starting to empty. So if you're moving reefer freight, great, you're still in a good place. Volume levels are still starting to tick up higher and higher. Now that orange line there, the tender rejection rate, sitting at right around 22.5%. That line is really starting to increase at a much faster rate than the volume levels. You can see right around June 14th, that orange line really starts to deviate from the volume levels. All right, so that means that spot market rates are really starting to rise much faster, and even though volume levels are increasing slowly, the rejection rates are driving much faster, meaning capacity is really starting to tighten up in the reefer market as carriers have a lot more options to choose from. So if you're continuing to move reefer freight, just be prepared. You may need to continue to raise your spot market rates across the board. Of course, all markets are a little different, which we will look at. We're going to dive into the Little Rock, Arkansas market here, which has seen a lot of decent volume. It's not the largest market in the United States for reefer volume, but it is up there, and it's continuing to push higher. The green line that you see there, that is the reefer tender rejection, sitting at right under 58.5%, which is exceptionally high and continuing to push higher and higher. That blue line is the reefer volume level, right? So again, it's nearly, after the 4th of July, it dipped down, and then literally it doubled right after that. So it cut in half and then doubled to get right back up to its near high since the beginning of May there. And that's really eating up a lot of capacity out of Little Rock. So as that volume levels continue to push higher, tender rejections are pushing higher, and of course tender rejections will drive up spot market rates. So if you're moving freight out of Little Rock today, I would be cautious. I would probably raise your rates from yesterday or even a couple days ago, whenever you last move rate loads out of Little Rock on the reefer market. Be prepared to pay a little bit more of a premium to your carriers as they do have those options to choose from today. Now we're going to look at a brand new update. We just launched our reefer predictive rates. It's still in beta right now, so it is the first iteration. There's a few updates going on, but I want to at least kind of show you a little bit about how it works. So right now, you've got today's rate there. We're going to look at the median rate, which is $2, just over $2 a mile. That is line haul, does not include any fuel surcharges or accessorials. So once you add that in, you're looking at approximately $2.20 a mile. And then what's really interesting, though, if you look a week, a month, even 3 months out, you can see a lot of softness is being predicted in the reefer market. So we'll see if that does continue. But as of right now, what I would try to do, it might be a good time to lock in rates with your shippers as before the reefer market starts to slide. And that'll do it for today's broker update.
Hello and welcome to your Rail Intermodal update. I'm here with Mike Baudendistel. Mike, what's the latest?
So the latest is Union Pacific just reported this morning, and actually shares are down a couple percent. CSX reported last night. Their shares are down a couple percent. I think a lot of those companies were really sort of priced to perfection. The valuations were trading at high levels. I was actually pretty impressed with the results, given how poor the volumes were in the second quarter. You're talking about Union Pacific's volumes being down 19%, and they still had an OR of 61%. So really, I think doing pretty well. You look at these rail car loads, and we've had kind of a quasi bowl-shaped recovery, still back to where we were in April. So really has rebounded quite a lot. In the past, I've talked about rail car loads really trailing intermodal units. So that's still true, but still down 15% in the last week, a lot better than the 20-25% we had been seeing earlier. When we break this down by commodity type, it's still pretty much a red screen showing year-over-year degradation, but seeing some signs of improvement. Chemicals, which that's down single digits, so that's a positive sign. Motor vehicles being up in the last week, so seeing a rebound there, and then forest products essentially being flat. So you're seeing certain sectors of the economy recovering. The ones that are not recovering would be something like petroleum or primary metal products down 20%. Some other types of metal products are down 30%. So really, some of those metals that go into capital goods are the ones that are struggling the most. So we're also seeing that with the flatbed carriers. Tender rejections for flatbed carriers only about 5%. So weakness in the industrial side of the economy. Intermodal, we've really had a V-shaped recovery. I mean, we're all the way back up to sort of near the highest weeks of the year back in February. I think the last week was the second highest week in 2020. So it's resembling much more of the trucking industry, and the fact that more of the goods are coming in through the West Coast ports. For that speed to get those products to market for stores that may or may not be opening, they want to have that inventory close to where it's going to be consumed. So seeing much better strength in intermodal, and what we're seeing from some of the carriers, Canadian Pacific actually had revenue per unit up, despite the volume difficulties earlier in the quarter.
And so going back to the rail and some of those quarterly releases, was it surprising to see that these operating ratios were so high?
Yeah, I mean, they're a little bit mixed. I mean, Canadian Pacific actually had an improvement in its operating ratio despite the drop in volume, which was pretty amazing actually. Both CSX and Union Pacific had some degradation in there, but it was from such a strong level that I think in the context of the volume decline, I thought it was pretty impressive. Particularly now Union Pacific 61 OR despite that volume drop of 19%. I mean, I think the valuations reflect that investors are excited to see what they can do when you actually see volume growth, which should happen maybe next year.
Excellent. And Mike, last thing, real quick, this recovery for intermodal, do you see this as being something that's sustainable?
Yeah, I think it is. I mean, depending on if we have another shutdown with the economy, but really the trucking market has improved to such a degree that it's made intermodal much more attractive on a relative basis. I mean, we really saw the trucking market improve first, then intermodal follow it. But the economics are such that you can save money now by moving intermodal. So it does make the economics quite a lot better, particularly in the longer haul transcontinental lanes, which have performed much better than the local east lanes.
Excellent, Mike. Thanks so much. And thank you so much for tuning in. That's going to do it for this Thursday edition of FreightWaves Now. Check out our FreightWaves TV app on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.